Value Invest Asia. My name is Stanley Lim. If you're new to us, Value Invest Asia is actually a financial media firm where we bring you independent research and straight to the point analysis about stocks across Asia. Value Invest Asia is actually founded by myself and two of my great friends whom I met when we are all pursuing our Chartered Financial Analyst program. And now together, we have all worked in the finance industry for many years, and our investment experience is close to 3 decades combined. And every year we try to publish a stock guide report, one report that we highlight and do a full analysis on 10 stocks that we really like this year. And the stocks is really selected based on our strict requirement on requiring them to be great businesses where they will turn out to be great long-term investment. Meaning that even though stocks that we highlight years ago should continue to be great watch list stocks for you guys after a few years. In fact, many of the stocks that we highlight in 2017 continue to do very well for investors since then. One example is VTROX Holding, which has actually returned more than 160% for investors since the day we published our report. And even through such a volatile market, we have seen companies that we publish, such as Tencent Holding or Alibaba Group, all returning more than 40% for investors over this period. So we are really looking for very high quality businesses. Most likely they have very unique business model and in a growing industry. And they have definitely demonstrated they must have high caliber management as well. After we found these stocks, we'll try to match them with 3 key values that we find in the stock market, namely asset value. So these are companies with great asset but underappreciated by the market, or earnings value, where companies are almost considered a money machine and a cash cow, just generating cash over and over again year after year very consistently. And lastly is growth value, where companies have huge growth potential that's not fully realized yet. So we not only make sure that these are great businesses with long-term prospect, we try to make sure that at the point of publication, this company possess at least some value for investors as well. And every year we will launch our stock guide through a grand webinar event. This is a full 2-day event where we try to detail and go through with you every single company on how we come across them, why we select them, and what are the risks involved in particular. And every year, all our participants has give us great feedback for us to improve, and also great testimonial on how much they get value from this event as well. If you have supported us in the past, I really want to thank you for your support. As we can only include 10 companies into our stock guide, definitely some of the companies that we research on and analyze on will not make the cut. So this company will end up in our reserve list. And we're going to talk about one such company today, which is Singapore Telecommunication. So this is a company that we continue to like, but unfortunately, due to some reason, failed to make the cut into our stock guide 2019. So this is what we think of the company. As you guys know, Singtel is the largest telco in Singapore. But when you look at its business, it's not really a Singapore-based telco, but rather quite the international one, because of its major stake investment in Optus Australia and also its associate investment in many telcos across Indonesia, India, the Philippines, and many other areas. So in general, telco has really seen a very strong sell down in recent years, mainly because investors is starting to question how sustainable is their business going forward, and we are seeing more and more competition coming into the Singapore market as well. So for a blue chip utility company, Singtel has fallen so much that it is now trading at just 9 times PE and giving a dividend yield of 5.8%, which is very attractive in our opinion. And unlike, say, its competition like StarHub or M1, we actually think that Singtel is in a very good position to defend its dominance in the telco space, and also the best position to be able to transform and find new avenues of growth for the future. And we think that the telco itself, the business model has to change, and mainly because if we look at more developed markets, say in Japan or the US, we're already seeing how telcos is starting to transition themselves in the new technological space. So one key example is definitely SoftBank, a telco in Japan. and it has really now grown to become more of an investment company than a telco. And one of the key investment that it make is actually in a company called the Alibaba Group, and that really put it on the map. And I think Singtel is actually following the roadmap of SoftBank of trying to move more into the digital space and transforming its business. And I think that's really the right way to go, given that we have also seen telco in the US, such as Verizon making the purchase of Yahoo assets, and also AT&T buying up Time Warner, trying to become more of not just a telco, but rather a digital and also media company. So if we look at Singtel now, its business, the revenue is still coming mainly from its traditional telco business. Geographically though, underlying profit, say 29% is coming from Singapore, 24% coming from Australia, and the rest coming from its associate. But it is really investing very heavily into the digital technology and enterprise services space, such as cloud computing, cybersecurity, and even smart city planning. And after many years of investment, I think we are starting to see some success in this space. Its digital life segment recently seen a revenue crossing 1 billion in sales. So that's definitely a key milestone for them. And we're also seeing some success in some of their products and services within this space. So we believe that Singtel is a company that has a very, very strong business in its telco space, although slowly declining, but with the cash flow coming from this business, they are able to sustain their dividend and also fund their future growth in trying to transform the entire business. Unfortunately though, Singtel just didn't make the cut in our stock guide 2019, still mainly because of the downward pressure of their telco business. We know that services such as voice, SMS, or even pay TV are really under threat and on a downtrend, mainly because as data become faster and faster, all these services can really be replaced by software applications such as maybe Netflix, your WhatsApp, WeChat, and also our Facebook. So as a stock guide, we really want all our company to at least be in a growing industry, because we believe that a rising tide will lift all boats. So that's the reason why Singtel didn't make the cut this year, but it is definitely still a great business that we like, with a very, very attractive valuation right now. So that's it for an analysis on Singapore Telecommunication. Thank you for your time. We actually come back tomorrow with a second company on our reserve list. And that company is a company listed on the Hong Kong Stock Exchange. It's called VTech Holdings. And this company has a dividend yield right now of more than 9%. It's very interesting, and stay tuned with us tomorrow on why we like this company and why unfortunately it didn't make the cut to our stock guide 2019 as well. So if you have any question regarding Singtel, or even on our grand webinar 2019 or our stock guide, do let us know below. We love to hear from you. And of course, if you feel that you have gained some value from this video, we hope you will share it as well to others who you think it might help. So thank you, and I'll see you tomorrow. Remember to check your email or on our Facebook page for the latest notification. This is Stanley from Value Invest Asia. I'll see you tomorrow.